Hello and welcome to ET. Now you're watching IPO Central, and my guest today is from Wakefit Innovations. It's a Bangalore-based home furnishing company. Its IPO is opening on December 8th, closes on December 10th. Price between 185 to 195 rupees per share. It has a fresh issue of 377 crores and OFS of 912 crores. So a total of 1289 crores is the IPO size. And joining me today is Ankit Garg, who is the promoter, chairman and CEO of the company, and Chaitanya Ramalingegowda, who is the promoter and ED of the company. Gentlemen, thank you very much for joining us today on ET Now. To begin with, Ankit, give us a sense of your company, the business verticals it has, and how long you've been in this business.
Okay. Wakefit started in 2015. We got incorporated in 2016. It's been about 10 years since the inception of the company. We are a vertically integrated home solutions company. What do I mean by that is that we are a company who sells mattresses, furniture, home furnishing, home decor, and we are also vertically and forward integrated in the terms of owning our own warehouses. We manufacture our own products. We do retailing by ourselves. We do online business ourselves. We are also unique in a way that we are a D2C home solutions, omni-channel home solutions company, which means that we directly access to our customers, sells them the merchandise directly from our company.
Chaitanya, you're raising 377 crores, and I understand that there was a pre-IPO of 56 crores odd as well. So what is the amount going to be used for?
There are 3 or 4 major uses of the IPO proceeds. First and foremost, like Ankit said, we are an omni-channel company. That means we are going to strengthen our offline presence by opening up more company-owned, company-operated stores which only carry display inventory, which means they're very asset-light retail stores that the company owns and operates in order to build a strong relationship with the customer. Second, we are going to continue to invest in marketing and advertising. While we have been a very frugal marketing aid company where we have spent only 7 to 10% of net revenue as marketing expenses, we will continue to invest steadily in the same range, neither taking it up nor taking it down, so that we are able to build good, strong memory structures in consumers' minds as a full-fledged home solutions company. That is the second big usage. The third big usage is on capacity expansion, mainly on capex for manufacturing, warehouses and retail, so on and so forth, which we are going to deploy as an investment which will pay off over a period of time.
You spoke about retail expansion there. Ankit, can you give us a sense of which are the regions where you are currently available, and when you say expansion of more stores, which is company owned, company operated stores, where all you want to expand from here on?
Yeah, I think our retail journey started in March of 2022. We opened our first store in Lucknow. Then we slowly expanded about 10 stores, mostly in metro cities like Delhi, Bangalore, Mumbai, Pune, Chennai, Hyderabad. But eventually in the year of 2023, we started expanding more in tier 1 cities and more stores in metro cities. By the time last year was completed, we had about 100 odd stores spread across mostly metro cities and mostly tier 1 towns, cities like Ahmedabad, Jodhpur, and cities like that. But eventually, now that we feel that we have got enough density of stores in metro and tier 1 cities, going forward we are going to expand our stores in tier 2 towns, tier 3 towns, cities like Mathura, Agra, Aligarh, Mysore, and many more cities. So it's a very metro tier 1, tier 2 based expansion instead of north, east, west or south expansion, because we believe we being an online company, specifically an omni-channel, eventually, but most of our customers are digital native customers. So we try to expand into the regions where we see that adoption of digital economy is the highest, and hence the flow of organically started from metro to tier 1 and then tier 1 to tier 2.
Yeah, essentially it's a land and expand strategy, because When we take up one capital city, then expand to tier 1, then expand to tier 2 in the same region, it gives us really good benefits and good ROCE on the logistics network that we end up building in that state. So that is the reason we start with one city and expand slowly to capital tier 1, tier 2 and open up across our product lines.
And when you say of capital expansion, are you going to set up more facilities? Because my understanding is that you have one in Sonipat, two in Bangalore, and two in Hosur. So, are you going to expand that footprint as well for manufacturing and warehousing?
We currently have about 5 manufacturing facilities, world-class ones, state-of-the-art ones, like you just mentioned. These have taken us a substantial amount of time to set up, import the machinery, learn from other industries like automotive, make it very, very stable, efficient. We are also improving the cost structure there using TPM philosophies in order to be very, very frugal and get the most output of those facilities. Given all of these expansions and investments that we have done over the last few years, our belief is that we need to squeeze out the most from this fixed asset and improve the ROCE steadily, and hence we don't see a need to add more capacity over the next 2.5 years. We believe that closer to 2-year mark from today, this capacity would be closer to being more and more utilized to 2.5 shifts, at which point of time we will have to think of fresh capacity. Based on the density of the orders, based on where a customer base is grown, we will choose those cities to put up the additional one. Yeah. And we need to think ahead because it takes us a year to set up. These are complex facilities.
Yeah, just to add, I think we as a company have the DNA of making sure that we manufacture our own products to our consumers, because we believe that the quality control, the speed of innovation, the uniqueness that we can bring out of the product is much better if we own the facility by ourselves. So by design, we tend to make sure that if there is a revenue potential for us, we will go ahead and upfront make an investment to make sure that we have the capacity available for our customers as and when needed.
Ankit, if I look at your business segments, mattresses account for nearly 61% of your revenues, followed by furniture at nearly 29%, and then furnishing at 10%. Mattresses being the biggest chunk of your revenues there, and when you are expanding into many various cities, tier 2, tier 3, what we normally see is that there are a lot of unorganized players in that, small shops that do local manufacturing of mattresses and other stuff. How do you plan to get into the city, and is that a competitive price competitive market for you in that sense?
Yeah, I think, valid question. We as a company have, whether it is a metro city, tier 1 city or a tier 2 city, we have seen and there is enough competition in all ranges of products that exist in the mattress industry. But I think, we have always seen in the last 10 years that what has worked for Wakefit, now that we have, become a very sizable business in mattress and probably in the top 3 in India, not only just online, that we are probably, top 2 company in India who's selling mattresses by revenue. What we have learned is that the true differentiation in terms of competitive intensity comes only when you are innovating for customers, when you're building policies for customers which are very unique, which are customer first. And that's where we believe that our edge lies. Like for example, we were the first one to bring 100 days trial period concept to India, which meant that you can actually buy a mattress from Wakefit, return them without even a single question asked, even after using for 99 days, which is very unique, which is customer first, because we believed that customer in interviews, when we asked them like, what is it that we can do for you, they said, when we go to showrooms, we have to make a decision in 20 minutes, maybe, sit down on the mattress and stuff like that. But we cannot really make out this mattress will work for us or not. But once we have bought it, we cannot return. So we created this 100 days trial concept. We were the first one who came up with the roll pack technology. Now our mattresses, which are giant size. Imagine everybody now lives in, high-rise apartments or multi-story apartments. It's very difficult to move mattresses from ground floor to, let's say, 20th floor or 15th floor, right? So we had to roll pack the mattress in order to bring logistics cost becoming very low. Plus, customer is able to move the mattress from A location to B location very, very easily. That we came up with. We also did backward integration and adopted TPM methodologies. Like we are probably the only company in India who is trying to build factories in a fashion that automotive companies in India have built, which meant that we could offer even lower cost to our customers because we had a lot of efficiency in our manufacturing and essentially in supply chain also. So I believe that if we remain committed to customers and we build policies which are customer first, we build products which are world class, we believe, we are able to offer better and better price for higher and higher value of the product. I think then, competition is very temporary in that nature, and hence we remain committed as a company to just constantly build on more and more assets which work for consumer, and that probably just lead the path to consistent growth and profitability.
You've been clocking a positive EBITDA for last three, means 24, 25, and then for the first half of this financial year. Your EBITDA margins are around 11.9%, and it's been increasing in the last 2 to 3 years there. Is 11.9% a normal EBITDA margin, or is there a scope to take these margins higher as you bring in more volumes and leverage your technology?
Yeah, we won't be able to give you a specific number about the future, but just want to mention that we are not a tech company where you can hire and fire people, or you can turn on or off a feature and then suddenly improve the profitability exponentially. We are a physical product company which is tech enabled, which means we have real factories, 5 of them, 20 plus, 25 plus warehouses across the country, people who have to be trained to service customers, whether it is installation, whether it is their post sales queries and so forth. So our efforts on profitability is not something that can be turned on or off like a switch. So it's nothing that we can do saying tomorrow morning I want to be profitable. So as a company with 10 years of existence and track record, the first few years we were EBITDA and PAT positive company. And then, like Ankit mentioned, we invested in creating one of the large facilities which are state of the art, world class, robot driven factories for furniture making. So during which time we had to take that greenfield project up, stabilize it, and increase the utilization quarter by quarter. So that's why we were in red for about a couple of years, and then we've again, over the last 12 quarters of hard work, we have put in efforts to bring in utilization improvement, efficiency improvement, and manpower improvement, so that today we are again back in profitability. The only thing that I can reiterate is that in our company efforts tend to be sticky because of the reasons that I just explained, which means whatever we have put tends to be sustainable, and operating leverage kicking in because fixed costs tend to remain fixed. Same store sales growth increasing because stores are maturing. Premiumization happening because we now have a lot more premium products which are not existing 2 years back. All of these things tend to point towards a better margin profile, but we won't be able to commit on specifics.
But is there a scope to increase the margin, or are these normal margins for your business? That's what I wanted to ask.
Oh yeah. No, I think there is definitely a lot of scope to further improve the margins from here. Our strategies are also inclined towards that. Like for example, offline expansion has been a great way for us to expand our gross margins. We continue to invest behind opening more and more retail stores. We've seen factory utilizations which used to be, let's say, 30% earlier. Now we're aiming about 60%, 70%, 80%. That would also lead to production cost improvement. Similarly, in the supply chain cost, logistics cost, there's a lot of levers. As a company, we constantly endeavor to find more and more efficiency in the P&L, pass it on to consumer most of the times. But if there's a requirement on EBITDA, we also do that. So I believe, yes, the answer is yes, we have a lot of scope to further improve from here as well.
Is there a seasonality in your business, Ankit?
There is a slight amount of seasonality, but we will not call it as a seasonality. It's because of the Diwali season. I think there is in India, we have seen that Diwali time, there is a lot of purchase that gets triggered, especially in our sector when marriages happen. That too, during it starts post the Shraddh period and it goes in the third quarter. So we have seen third quarter generally does better than more, other 3 quarters. But the ratios are not so off that we can call this as a seasonal business. But yes, third quarter seems to be doing better than the other quarters.
The reason I'm asking is that your advertising expenses is around 5.1%, and I've been looking at last 3 years, and they're around in the range of 7.5% to 8%. Is it because you had curtailed your advertising expenses, or or it may be 7.5%, 8% is a normal level of advertising expenses going forward?
We will come to the similar ranges only. It won't be a drastic decrease or drastic increase, because on a base of revenue that we are doing, 7.5% is a fairly substantial absolute number in crores. So we will continue to invest that. And you're absolutely right in your guess that Diwali quarter we do end up increasing the marketing spends a little bit more to come in line with the whole year. And more than the budget, our marketing estimation is more zero-based budgeting, because every year the digital platforms, their algorithms, influencers, what happens on different ecosystems online, YouTube versus Instagram versus Facebook, all of that keeps changing. So we are always based on what is the return on the advertising spend. And so sometimes it goes up to 8%, sometimes it stays at 7%. It's much more of a business decision based on that year's trends and CPMs and CPCs.
As we are expanding more and more retail stores, we have seen that the dependency on marketing dollars has reduced over a period of time. What we're seeing is constantly when people are noticing us, there's a shop which they pass by, let's say almost every alternate day, the brand salience become much more powerful, and hence the need to spend a lot of dollars on marketing reduces. So I think it's a balanced effort we're trying to make. But yes, you're right. Somewhere in between 5% to 7.5% is what we feel as on today that we might continue to spend on. But lot more to, as like Chaitanya said, like we'll discover more as the market matures over a period of time.
So so Q3 and Q4, your margins will be under pressure, because if you increase your advertising spends, that will be the impact on the EBITDA margins in that sense.
No, margin won't be under pressure because the volumes grow more disproportionately, like Ankit mentioned, and the discounts and all are not as high as a pure play marketplace driven company. If it's a pure play marketplace driven company where you're selling on third party platforms, it is very much driven by what discounts, what bank offers you're able to fund. But as an omni-channel, omni-product company like ours, where a large part of sales comes from company-owned, company-operated stores, where premium products are sold through upselling, consultative sale, understanding of the customer's requirement and recommending specific products to them, the impact on sale event because of pure discounting is much lower. And secondly, in our product categories such as furniture, such as decor, these are not impulse purchases. These are well researched. People usually take 2 to 3 weeks to research, then shortlist, then come with their whole family to the store to make a decision. So these are not price driven or impulse driven categories like apparel, and hence 500 rupee or 1000 rupee here or there does not matter to them. What matters is durability, warranty, trial period, and that is where we try to focus a lot of our energies on.
True. Your revenue from online marketplace is around 29% and it's been healthy and growing. Will that have an impact on how much discounts that you give? Because in online and third party or multi-brand outlets where you sell your products, discounting and price competition is going to be high.
On the marketplaces side, we believe that we as a brand have been able to build a very solid proposition for our customers, and it is also enhanced by the number of quality customers and quality products that we've sold to those customers. Like it's a reflection. Like if you go to Amazon, Flipkart, the marketplaces that we try to sell on, we have garnered maybe about 4.4 star rating, 4.5 star rating for most of the products that we sell, with maybe 70,000, 80,000 reviews on each product side. We have about 10 lakh plus positive reviews there, which is a testament to the quality that we have been able to build over a period of time and the trust that the customer has shown us by buying some of the products over there. So hence we feel that the discounting is a very temporary thing, even if we have to do this in this quarter. But as Chaitanya said, that absolute basis margins are going to be much healthier because the volume growth that we see in the third quarter is much higher compared to the discount we make, and hence we don't see that margins on even marketplaces are going to be under pressure. We believe that absolute basis will make more money.
Fair point. My final question to you is with respect to your courier and delivery charges, right? Means it's around 8.2 or 8.3%. Last mile delivery is always the highest cost thing in the industry, especially for retailers. Is there a way you can bring it down?
Definitely. Like Ankit started his first response, we are a vertically integrated company, which means we own everything from product design, engineering, manufacturing, logistics, sales channel, and brand. That means when we say we own logistics, which means nearly 65 to 70% of all our products travel through our own logistics network and not depend on a 3PL, which means we are able to set up hub and spoke model in the different cities where we have the clusters of orders, and we are able to utilize middle mile trucks and last mile trucks to the best efficiency possible. And we have also been able to manage a variable delivery based or unit based pricing with most of our local entrepreneurs. So the idea is to have excellent service for the consumers at a much lower cost than what 3PLs can provide, at a higher degree of certainty that on time in full delivery will happen. So because of that, nearly 65-70% of products travel through our network. So the endeavor is always to increase utilization and reduce the price. While beyond this, it doesn't make sense to us until there is critical mass. There we are still dependent on third-party logistics players, 3PLs. They have been our good partners, but they have their own constraints in managing heavy and bulky products. So we will continue to endeavor wherever there is a density of orders, we will go and set up our base in order to give this. Think about it, because we have furniture, not only do we have to deliver, in the same visit we send our own fitters who can go, install and give an excellent customer service and come back out of the house. So that is the reason we believe that it's not just about delivery, it's about multiple moving parts that we are owning in order to be customer first.
Gentlemen, it was a pleasure talking to you today. Your IPO is opening on December 8th and closes on December 10th. Price between 185 to 195. It's a 1289 crore IPO, which includes a fresh issue of 377 crores. Thank you for joining us today on ET Now.